morning and welcome to the Video CPA. It's a snowy day in Idaho on the 19th of February. So starting the middle of tax season. So it's good to be with you once again. Today we're going to talk about not income tax so much, but we're going to talk about gift tax versus estate tax. It's going to be just a primer, give you a little bit of information on what the differences are between the two. So we're going to start off today with our affiliate marketing disclaimer, and then our educational disclaimer, as you see all the time if you watch these videos. Now, what is gift tax? Gift tax is computed on the value of items that you're giving to another person. Okay, and that could be a total gift that you give away. It could be a partial gift. It could be an income stream. But any of those things that you give away to another person could attract gift tax. And so you need to be aware of that. And I think this is probably one of the biggest areas where we see clients that don't really realize that there is a gift tax and how the gift tax works. And when they give something to their kids or something given away, they don't really realize that they're supposed to file a tax return on it. So this is where CPAs and professional tax preparers have an opportunity to educate their clients a lot of times. So you're supposed to use Form 706 when you give anything to a single person over $15,000. Now, $15,000 is the annual exemption. You can give gifts up to $15,000 to as many people you want during the year. But if you give over $15,000, you're supposed to file Form 706, which is the gift tax return. All right. Now, there are some exceptions on that. Gifts for tuition and medical expenses are not subject to the tax and reporting. Gifts to spouses, gifts to political organizations for their use, gifts to qualified charities, they're excluded from gift tax. But everything else, if it's over $15,000 to a single entity or a single individual, you're supposed to file Form 706, the gift tax return. Now, most clients, most people that aren't tax professionals have never seen a Form 706. So you may have to go to a tax professional actually to have your gift tax form prepared. And I would say this, that filing of gift taxes is probably the most underreported area in the IRS, because a lot of people just don't know they're supposed to do it. And sometimes, I mean, even if they don't do it, it doesn't make any difference in most cases. So let's go ahead and look at how the gift tax is computed so you can see what I mean. When most people file a gift tax return, there is no gift tax due. All right. You file that return, you add up your gifts for the year that are taxable gifts, over $15,000, for example. And then you compare that to what's called the estate and gift tax exemption. For 2021, that estate and gift tax exemption is $11,700,000 per person. Okay. Now, most of us are going to come under $11,700,000 for our estate. Okay. So if that's the case, there will not be any tax on this gift tax or other gifts that you might give during your lifetime. But a gift tax return is still required. Okay, so that $11,700,000 is inflation adjusted. In 2018, it was actually the gift tax was the gift tax exemption, the estate and gift tax exemption was actually doubled up to $2 million, and because of inflation adjustments, or up to $10 million, I'm sorry. And now because of inflation adjustments, it's up to $11.7 million, and next year it'll be a little bit higher. And that goes through the end of 2025. And then the law expires and the gift tax and estate tax exemption will fall back down to $5 million unless the law is extended. Now, the Biden administration has already said that they would like to have a gift tax exemption lowered to $3.5 million for estates and $1 million for gifts. So we'll see if that happens. But that's where it is right now. And through 2025, unless the Biden administration does something about it, it's going to be up $11-12 million in that area. Okay. So, you know, your reportable lifetime gifts, none of them are going to be taxable unless they exceed $11.7 million. And that could even be more when you pass away. It just depends on what year you decide to check out. Okay, so if tax is due on these gifts, it's generally paid by the donor. And so you need to be aware of that. The donee does not, or the receiver does not pay the taxes usually, unless you arrange with them ahead of time that they're going to pay the tax and make some elections so that can happen. But normally paid by the donor of the gift. All right, so let's talk about gifts, and this is pretty important here because most people don't realize this either. When you receive a gift, and say in this example you received a gift of property, undeveloped land, okay, and the donor purchased the land 40 years ago for $1,000 an acre, okay. So he gifts it to you, and at the time he gifts it to you, the land has gone up to $10,000 per acre. Okay, so you turn around and sell it. Then it could be a year later, it could be a couple of days later, but you sell it for $11,000 per acre. Okay, when that happens, your basis in that property is the basis in the hands of the donor. Okay, so that means that if he bought it 40 years ago for $1,000 per acre, that's what your basis is on a gift. So in this case, your gain per acre would be $10,000 on that property. All right, and that's pretty interesting, and it's pretty important to know, because if you receive it through inheritance, it's different, and I'll talk about receiving it through inheritance a little bit later. So just remember, your basis on a gift is the basis in the hands of the donor. It's not the fair market value at the time of the sale, or it's not the amount of you put upon the gift, you know, when you receive it. Remember that, because we're gonna come back to it in a few minutes. All right, so let's look at estate tax. All right, so estate tax, basically within estate tax, you're going to add up everything the deceased guy owns, whether it's stocks, bonds, boats, property, real estate, whatever. Add them all up. You're going to subtract a few deductions. Once you add them all up, you're going to have your gross estate. You're going to subtract some of the deductions that you're allowed, and that's going to be your taxable estate. And then you're going to apply a tax rate to it. Okay, so it's everything that you own. All right, and again, that exemption amount is $11.7 million in 2021. Okay, now estate taxes are reported on Form 709. All right, so 706 is for gifts, 709 is for estates. Now, one thing to keep in mind is if you're a married couple, if you're under the $11.7 million, you really don't have to file a tax return, an estate tax return. But there is a reason to do so. And so if you're a married couple, the surviving spouse might want to file a estate tax return. And that's because the law allows the living spouse to elect portability to transfer the estate and gift tax exemption that the deceased person had over to him or her. All right. That would mean that if, for example, your husband died and it died in 2021, and so the estate and gift tax exemption was $11.7 million. If you did not file or you did not elect to have the portability transferred over to you by filing a Form 709, when you die, you're, and it depends on the year you die, but if you died in 2021 also, your estate and gift tax exemption would be $11.7 million. If you elect portability and transfer his exemption over to you, well, then your estate and gift tax exemption is twice as much. So it's over $22 million. So that might be one reason that even though you don't owe tax, and even though you're not required to file a Form 709 for your estate, you might want to do so. And especially in situations where you're fairly close to the $11.7 million. But even then, I mean, if you happen to win the lottery or something, this would be very helpful to you. Now, I talk to clients about this quite a bit, and most of them don't want to even mess with it because, their estate's $500,000 or something. But it just depends on the individual. But it should be brought up, and you should think about it, whether you want to do this or not. And if you're using a tax preparer, which most people do to prepare an estate tax return, or when their spouse dies, they should be mentioning this to you. Okay, so just be aware that that's out there. All right, so the tax is computed, as I mentioned. You take the estate tax rate against the taxable estate, and the estate tax rates are high. They start high. So do the gift tax rates if you're subject to gift tax. But if you exceed the $11.7 million, then you apply that tax rate to it. And the way the gifts come in is that you'll take your gifts over the lifetime that have been reported by you, your taxable gifts, on Form 706. You'll add those up, and you're going to add them into your taxable estate before you apply the tax rate. So that's the way the gifts actually come in. So they could drive you up over that taxable amount. They're giving you a break by not taxing you on the gifts right away, and maybe never taxing you. But when the deceased person dies, he's got to add all those gifts, reportable gifts, into his taxable estate. Okay. All right. Now, if you sell something that you received through inheritance, there is a difference, and I mentioned that because if you happen to sell something you received through inheritance, you get what's called a stepped-up basis. Okay, that means that when the deceased person dies, you get his basis in that property, or your basis in that property for the beneficiaries, is stepped up to the fair market value on the date of death. So let's look at that same example again. You bought the land 40 years ago for $1,000 per acre. The land's appreciated to $10,000 at the date of death. So your basis now, instead of $1,000, becomes $10,000. All right. You turn around and sell it a year later for $11,000, and your gain is only $1,000. So it's much better to receive, for the beneficiary anyway, or the receiver, it's much better to receive the gifts or these items of property through an estate, through inheritance, than it is through gift, because your taxes are much lower on it if you turn around and sell something. Now, on the other hand, your donors have they're influenced actually to do it the other way. I mean, they're better off giving it to you because as a gift instead of through the estate. But be aware. I mean, there is a difference between how you receive it, and if you receive it by gift, you're not going to have as favorable tax treatment. And maybe you don't care if the donor is paying the tax on it, but you won't have as favorable tax treatment as you do if you receive it through inheritance. Okay. All right. So that's the primer. You just need to know the difference between gifts and estates. I mean, there's a lot more in this area, but those are some very basic concepts that will help you when trying to decide whether you're going to gift something or whether you're going to just, you know, not gift anything and let it pass through inheritance. Or, you know, how you're going to receive it if your parent is getting old, or whoever it might be getting old. So think about these things. Thanks for watching, and I'll be back with you next time.